And good afternoon, everyone. After a lot of bad weather, here we are with a little bit of a sunny day. We are the Price Group. My name is Randy Price. He's Matt Price. And as we do every first portion of the year, we will take a forward look at the year to come, 2023. If you're like me, you're still getting used to that. But the title of today's webinar is Investing Themes for 2023. The trains run on time, 30 to 40 minutes here with some time for questions. Who are we? The Price Group, family owned and operated, several years of experience between myself and Matt. We are a fiduciary and follow fiduciary-centric planning and investment recommendations. And retirement is exactly what we do. Over 80% of our clients are either retired or very close to retirement. So welcome. Glad to have you with us.
A little bit about who we are. There are quite a few clients on the call, so welcome all the familiar faces, a few new faces as well, so more for the new faces. But Randy's been humbled by Barron's, Forbes, Financial Times to receive some accolades, which we're proud of. We both, Randy and I, have our CFP, Certified Financial Planner, along with the Certified Investment Management Analyst designation. We think education is critically important and something that we take very seriously here within our team. Maddie Kearns also is the third CFP on our team as of last year. Steward Partners is the name of our firm based off the biblical definition of stewardship. Like Randy mentioned, we serve as a fiduciary, so we're not owned by a bank. We're quite keen to that as well. Raymond James is our custodian meaning where client assets are held. And there actually will be a few more custodial options rolling out with our firm here later this year. But Raymond James has been a great partner, and we appreciate all they've done.
If you've participated in any of our webinars before, you know we like to start with a little bit of warm up the brain exercise. So we'll start this out with a couple of questions. At the end of 2022, just passed, which country had the most powerful passport? Was it Germany, United States, United Arab Emirates, or Japan? Drum roll, please. United Arab Emirates was most powerful passport. Germany's score was second, United States was third, and Japan was fourth. Their score of 180, and it's a passport index whether a visa is required to travel to that nation, and actually the ease of doing so. Anyway, now you know. Beautiful picture there. So 2022 in review. Let's talk about 2022. Have you ever been on a plane flight? Obviously, I would say everybody has, and you hit some turbulence. The plane starts bouncing up and down, and it's certainly not a fun experience, especially if the turbulence is quite severe. But you probably may think, is the wing going to break? Am I going to get off the plane alive? And we sort of paint that picture as an analogy for 2022. The markets hate uncertainty, and 2022 was indeed a year full of uncertainty about the Federal Reserve, uncertainty about inflation, uncertainty about Ukraine, uncertainty about war, uncertainty about COVID-19, so on and so forth. So, you can mix in China, you can mix in, and so we had the financial markets go up and down. This slide talks about inflation rose around the world. And you can see that color-coded United States obviously is in that 5 to 10%. So you say we may have been the dirtiest shirt or cleanest shirt in the dirty laundry, but inflation is a hidden thief. 12% inflation will double the cost of living in 6 years. 10% inflation will double the cost of living in 7 years. So inflation is something that, as planners, as fiduciaries of our client monies, that we need to be aware of and planning for. What happened? Central banks raised interest rates. Central bank here in the United States is obviously called the Federal Reserve. We went from near zero to almost 4.5%. There was some quantitative tightening and most aggressive in 4 decades. What that did was raise interest rates. The good news is if you had money in savings, you got it in the right place. You're now earning some interest on savings. What it did was put pressure on fixed income, interest rates up, bond prices down. And this was in view of also the Fed's goal to slow down the economy. Whole books will be written about what the Congress and what the government did, whether it was right, wrong, or indifferent with regards to the COVID response, et cetera. But again, the Federal Reserve stepped in and they said, we're going to slow inflation down, and they may still be at it. The Federal Reserve meets the end of this month and may increase interest rates again by some people say 0.5%. Stay tuned.
Randy, one good question we've gotten from a few clients. They said, well, if the short-term interest rates are yielding 4.3%, why didn't we see that during 2022? And it's a good thing to kind of paint a picture. This time last year, interest rates were still really close to zero. So you saw a majority of the increases happen in the summer months and then into the fall months as well.
So in inflation, the bugaboo of the long-term financial investor, because when you spend dollars, you spend dollars in real after inflation adjusted means. And so, you look at a postage stamp and you say, wow, way back when you could mail a US letter for 3 cents. Now, what is it? 57 cents. So here we are, the contributions to CPI, Consumer Price Index inflation. And you can see the inflation was steadily rising and it started dropping off. That didn't mean inflation went away. That just meant the rate of increase of inflation was slowing down. Obviously, if you paid or looked at your gas bill, your electric bill, it's higher. People are talking about how expensive eggs are. Just one thing in the grocery basket. Everybody knows a story about used cars and new cars, medical care, housing, et cetera. The chart breaks that down. But the good news is inflation does appear to be easing, but the bad news is inflation is much more pronounced than it has been in several years past.
So let's take a look at the jobs growth figures. This is a chart dating back from 2013 until the end of last year. And the thing that is a little bit of a head scratcher for a lot of economists who are calling for a deep, dark recession is the job market continues to be really strong. There are a lot of job openings out there. It's still an employee market, meaning the employee has more leverage than the employer in most cases. This is actually, last year was the second best year for job creation, dating back to 1939. So it's still a robust market. We're starting to see that weaken a little bit, but 2022 continued to be a great year for jobs. Real personal income, real means adjusted for inflation. So if inflation was 3% and you got only a 3% raise at work, you didn't really get a quote unquote real raise. With that being said, we've seen real incomes move higher. This is good for discretionary spending, something we'll talk about in a little bit. The consumer as a whole makes up about 2/3 of the US economy. And so with that being said, the real income that each of these consumers has to spend is a big deal when you zoom out and look at everyone together. So this also is good news for the consumer that incomes did move up. This is, when we put this together at the beginning of this month, this was true. It started to become a little bit, I'd say, less true toward the end of this month, but consumer spending is continuing to be resilient. You saw the December retail figures, which were some of the metrics on how much money did the consumer spend in the month of December. They were lighter than expected. So it looks like consumers are starting to pull back a little bit with their spending. But thus far, since COVID, really the middle, maybe end of 2020, consumer spending has been robust and has really kept the economy afloat. How long can that last? No one knows, but we are expecting consumer spending to see a pullback in 2023. And this was a chart that we used in the last halftime report last fall, and we got 2, 3, 4, 5 emails saying that was their favorite slide in the presentation. We thought it helpful to include it again in this presentation. The Q4 numbers for 2022 are still being finalized, so we'll get those, I think, here in the next few weeks. But for the most part, what this tells us is the net exports are how much are different companies or countries, excuse me, buying from America, which America really doesn't have a whole lot of control over. What we are most focused on in the GDP, the overall economic growth or decline in our country, is the consumer spending and also the business investment. Where consumers are spending and businesses are continuing to invest, good things typically happen. So you can see this broken down for the first 3 quarters of last year. The consumer did great, but you can see business investment did start to slow kind of middle of last year, which is usually a forward-leading indicator of what is to come in the months ahead.
So home prices and rents have cooled off a bit. The housing market may be the place where some of the Federal Reserve says their most dramatic impact. I mean, think about that. See mortgage rates that were down in the 2s, and they're now up in the 5s and 6s. So what that translates is that if you're buying a house, you are not able to afford as much house as you would have, based on interest rates that are over twice what they were just the beginning of last year. So you see the housing prices as of October of last year, still up 9%, but they had been down over the previous 3 months. Rents were also a bit lower. And again, this is going to slow, most people think, the housing numbers over time here. We talk about recessions, and a lot of people sort of gasp when they say recessions, but let's talk about what a recession is. A recession is 2 straight quarters, 3-month periods, if you will, where the economy actually shrinks, does not grow. And so a recession can be basically just tiny, it can be medium, or it can be a big recession. And what people obviously are fearing is the really deep, the really severe recessions. And the problem with the word recession is it's sort of like the word depression, which again, totally different things. But if we look at what many of the economic people take a look at, economists take a look at, is whether the 10-year, the yield of the 10-year bond less the yield of the 1-year Treasury bond, and the dates are shown there on the left, and it's been a good predictor of we'll have a recession. And so recession there in 1956, 1959, on down, and typically the lead time to recession there is anywhere from 7 up to 24 months, the period there where the recession starts and the recession ends. So the graph on the right shows the 10-year Treasury bond less the 2-year Treasury bond. And again, inverted yield curve is one of the things that people talk about on TV with regards to the economy as being a great predictor of a future recession. Again, recession can be very mild, as we're going to talk about. We're in the mild recession camp, and mild recession, if somebody didn't tell you, you probably wouldn't even know it. So anyway, there we go as far as recent recessions.
And Randy, on that image on the right there, these two, the 10-year and the 2-year bond became inverted on July 5th of last year. So we're approximately 7 months in. So like Randy said, anywhere from 7 to 24 months is historically how long it takes for the recession to quote unquote arrive. So our best guess is sometime later this year, but we're just really in the early innings of historically the window of when this does happen.
What a segue, young man, on in the early innings. Many of you remember Yogi Berra. It's tough to make predictions, especially about the future. Yogi had several great sayings about that. And again, we're on the clock as far as that. And our goal is to bring some information and also make adjustments as far as investment portfolios are concerned with regards to, how do you invest during a recession? How do you invest during periods of inflation?
So let's take a few minutes and we'll look at what did the financial markets look like for last year. One client cut me off when I was having a call with him a few weeks ago, and he said, "Not good, period." and it's probably a very efficient way to go about that. But here's a look, 4 quadrants. So where we want to be is in that lighter shade of blue, the upper right-hand corner, which represents a good year for bonds and a good year for stocks. You see, historically speaking, that's 72% of the time. With that being said, in the bottom right-hand corner is when their stocks are positive, bonds are negative. Top left, tannish, are good year for the bonds, not so good year for equities. And the outlier where you don't want to be is the bottom left quartile where we were last year. A bad year for bonds and also stock investors both. And this happened only 2% of the time. So we would say this is an anomaly from a standpoint, just history does not repeat itself, but it often rhymes. And you rarely see stocks and bonds down both in the same year. And we'll talk a little bit more of why that is. But this is another, I'd say, interesting chart. This is January 1st of 2022 for the first 6 months of the year, so through the end of June, and the number of days where there was more or less than a 1% move with the S&P 500 or the overall stock market. And you see that 2022 crushes its competition. No one's close. The second place is back in 2009 with only 73 days in the first half of the year. So to say 2022 was a roller coaster is a true statement when compared to history. One of our themes that we'll talk about, we think 2023 is going to be less of a roller coaster ride when compared to 2022. I think there's still some bumps along the way, but not nearly as many bumps as we had last year. And a little bit of a busy chart here, but let's put the decline into perspective. And when declines happen, historically, what happens moving forward? So after a 15+% decline, and I'm looking at the bar chart there on the right, when we look forward over the next 12 months, there's an average return of 10%, round numbers. Over the next 3 years, you average an 8 to a 9% rate of return each year. So once again, history is not something that repeats itself. It often rhymes. And so when markets do have pullbacks, the forward-looking returns are often more positive than the overall just averages. And this is another good look at that. Draw your attention to the bar chart there on the left. There have only been 3 other times in history, dating back to World War II, when the stock market has had back-to-back down years. World War II, self-explanatory. The inflation oil embargo back in the early mid-70s. There's a lot written on that. And then the tech bubble, 2000, 2001, and also 2002. We don't think that there is really a bubble like there was back in the late 90s. You saw a lot of these technology stocks pull back the most, and a lot of the, we think, excess fat has been taken out of the system. So no one knows for certain, but we would say we would look for 23 to be a positive year, just based off of history, based off the fact we don't have a what I would consider a systemic issue, meaning something that is affecting the overall, all aspects of the economy.
This is some interesting information. Investor sentiment survey, which has been a very good contrarian indicator. When people are bullish, they typically buy stocks, and when they're not bullish, they're bearish, they sell stocks. And so when optimism dips lower than usual, historically, above average market returns have occurred. The opposite thing. I mean, think about this. I mean, when was the best time to buy stocks? If you go back, well, you know, in spring of 2020 with COVID, or 2008 or whatever, the old term blood in the streets and so on and so forth. But you know, there was pessimism abounded, and yet that was the best time to buy. So if you believe this contrarian indicator, as of the end of last year, investors were more bearish than usual, and that would lead us to being, again, more optimistic for this year, 2023. We are big believers that what you own matters. We like companies that have earnings. We like companies that pay dividends. Those of you that are clients, we talk about tongue-in-cheek that being our secret sauce, and we have some different flavors of Dividend ice cream. But fundamentals are back in focus. Is a company over indebted? Is a company making money? Do they have good cash flow? More than just an idea, a hope with regards to make money. The better fundamental companies outperformed last year, 2022, and the more speculative areas of the market were hit in 2022. Companies that didn't have any earnings, companies that had a lot of debt. Matt, I'm reminded of some people that had come in and they said, well, tell me the bad news. And we were going and reviewing 2022. And I said, what do you mean the bad news? And I heard the story about how their neighbor had been invested, and, you know, the neighbor was down very large. And anyway, they thought their account was going to be down also. And the neighbor owned a lot of companies that were not fundamentally strong. A lot of technology companies, a lot of companies that didn't have a lot of earnings, and those stocks did get hit the hardest. And they were very pleased looking at their account with regards to you know, dividend stocks and stocks, again, fundamentally strong companies. So again, back in focus, we like that. We think that's healthy, and that is one of the things as we look at 2023 we see also. Some expect earnings to grow, and despite concerns about the recession, most people that you look at or listen to think that there will be some earnings growth in 2023, perhaps more in the second half than the beginning of the year. Obviously, energy prices, obviously interest rates, obviously what happens with regards to several things. Geopolitical tensions will enter into that, but we are of the camp that there will be also some earnings growth next year. We're going to summarize our thoughts a little bit later in one of our later slides, but look for earnings to grow. And if earnings grow, we expect dividends to grow also. I remember taking a look in first part of 2009, and our dividend stock portfolio had grown their dividends even after the great financial crisis. And so again, if you pick good companies, the safest dividend is the dividend that's just been paid. Price to earning ratios, the S&P 500. It's difficult to compare to other decades because interest rates continue to be low compared to the other time periods, bonds being an alternative investments. But this is a graph of the years on the bottom, and the price earnings ratios there measured on the vertical axis on the left side. And so you see that PE, the price to the earnings generated being a little bit less than 21.
And Randy, something I like to point out on this chart, clients will say, well, shouldn't we wait till the price to earnings get lower? Or what they're really asking is, shouldn't we wait till stocks get cheaper till we buy them? And when was the best time in your career to buy stocks? I think it's a pretty compelling argument to say it was spring of 2009. And what you can't even see the top of this on the bar chart is spring of 2009, where earnings per share actually were the highest before stocks did start to recover and the market was the lowest. So buying stocks when the price to earnings are low, it's helpful, but it's not an end-all be-all, meaning we want to look at this as just a piece of the overall pie when looking at our stocks worthy of your investment. And Randy gave me the difficult slides. The stock's not doing well, the bond's not doing well. Here's a look at the bond investors. And we said there in the goldish yellow, is it the worst year ever? And we're just dating back until 1976. If you're using that time period, the answer is yes. The bond market as a whole into the year down round numbers 13%, which is since 76 the worst year on record. This is one of our themes. We actually like bonds going into 2023. We think they'll do more of what they're supposed to do and be the ballast to the ship. You're getting more income from bonds than you were this time last year. We're gravitating more towards higher quality than lower quality, which is a little bit of a reverse course for the last few years and how we've looked at the fixed income world. But just with one bad year in the bond market, we're not of the camp that we should just throw our arms up and get out of bonds altogether. So yes, definitely was a bad year. Happy to report some of the pieces of our fixed income portfolio held up better than the overall market. For example, some of the floating rate bonds down considerably less than the 13% in other pieces of the portfolio as well. So we think it's even more important moving forward to have a process for your fixed income. And last year was a good litmus test for that. And like I said, we think there are better days ahead for bonds. Bonds, historically speaking, tend to perform well after inflation peaked. And we saw in an earlier slide, we think inflation peaked last fall, fall of 22, kind of around that 9% figure. Inflation's index to around 7%. So we should be a few months removed from the peak of inflation. And then in addition to that, bonds also tend to perform well after the Federal Reserve stops increasing interest rates. So this is a big conversation that a lot of the talking heads on TV will have on a daily basis. It's expected that the Federal Reserve increases interest rates here in the next week or so by 0.25% to 0.5%, somewhere in that range. And then there's talks of one more interest rate increase after that. Obviously, no one knows. If you look at the projections this time last year, everyone's projections were way off. But with that being said, hopefully we will see the Fed pause. And if and when the Fed does pause raising interest rates, that usually is a catalyst for the fixed income market as well. And so the last kind of piece on just some perspective, hopefully showing the forest opposed to just looking at the trees. This is a look at a balanced portfolio. So 60% stocks, 40% bonds. It would be a medalist if we had the Olympics for worst years. Only 1974 and 2008 have been worse. With that being said, when you do look back after 76, after 1974, after 2008, there's typically a reversion to the mean with long-term investment returns.
So we reviewed 2022. Let's take a look ahead on what May 2023 would look like. We don't think there's clear skies, but how long will the bear market last? This bear market looks pretty normal so far. And there's a list of the start date and end date and the change in the unmanaged S&P 500, the 500 largest stocks. If you look at the very bottom one, January the 3rd, 2022 through 10/12 of 22 was down 25%. Ouch. 9.3 months. Recession, still a question mark there. Fairly close to the averages, the average of about 24% down in 7.1 months is the time period there. So pretty normal. The market on average down about 10% at least once a year. On average, down at least 25 to 30% every 3 years. Sometimes we'll say, well, it's driving me crazy. But again, that's been behavior of investors, individual investors in the stock market over time. And again, we've got our fingers to the pulse, but you know, we are cautiously optimistic as we move forward. Speaking of cautious optimism, we do expect a mild as opposed to a severe recession. Remember, I said a little bit earlier, a mild recession. If you didn't know it, by somebody telling you that statistically it occurred, you probably wouldn't know about it. You know, a severe recession is where there's a lot of job cuts, a lot of things that cause more and more pain in the economy. And even though we are seeing some of the tech companies make some rather large job cuts, Houston and Texas, because of energy prices being higher, are proving to be recession resistant. But slowing consumer spending, Matt talked about that being 2/3 of the economy, and also potential weakening in the labor market, probably what will lead us to a modest recession in 2023. The dwindling consumer excess savings, you know, it really hurt for a while, paying $4 and $5 a gallon for gasoline. And so people used up some of their savings. When you're spending that much on things that you hadn't planned in the budget, then you don't have the extra money to spend on some other things, and the economy does slow down. So there's the forecast there on the left-hand side, and then on the right-hand side, we look at both goods spending and also services spending as well. Matt talked about the Federal Reserve and what they'll do at the end of the month. Again, expected the end interest rate in March is going to be about 5%. So there could be one, there could be two more increases, and then a pause. You know, the Federal Reserve is operating under the best information that it's out there, and supposedly some of the smartest people in any room anywhere. But they are making decisions with some past information in a period that really is a little bit different from some of the things that have gone on in the past. But do they tighten too much? Do they not tighten enough? Time will tell. History will report. But typically 6.5 months after the last tightening, the Fed cuts, you start to see rates start to decline. So anyway, there's a little bit of a graph showing where we've been, where we are, and stay tuned. We'll certainly keep our finger to the pulse. But again, this is one of the fastest interest rate increases since 1980. And if you're counting on your fingers and your toes, you know, that's a long time. That's 42 years. For some people, this is the first time they've ever seen a bear bond market. And it's as many times as we've talked about it, we knew it was coming, but when it gets here, it's still not any less painful because of the fact that a lot of people have not been through that. Talked about inflation. As inflation moderates, we expect the end of the tightening cycle. Sometimes the Fed tightens too much. We see the economy slow down more than the Federal Reserve expects, and so then they begin a cycle where they begin lowering interest rates. And again, all eyes are on inflation, what that looks like. And if the Fed is pleased with what they see, perhaps they end their tightening cycle in March of this year. And you see the inflation drop. As we talked about, inflation being the hidden tax, that would be welcome. Obviously, used car prices could come down, energy prices could come down very easily, and some of the things are a little bit more sticky, but the raw material costs, the labor costs, the interest costs are big inputs into for the consumer as well as for the corporations.
Another good question we've gotten, Randy, is in your Live Well plan, you guys obviously make assumptions for inflation, and our base case over the years has been 2 to 3% inflation. And over the past few months, clients have said, well, why are we not increasing our inflation assumption in the plan? I think that's a great question. It's good to take a step back and remember our Live Well plan is a document that we're trying to use and estimate the rate of inflation, not now or not next month, but over the next 1, 2, 3 decades. And so you can see here in the chart on the right, we're expecting inflation to be back more in that 2 to 3% range in the next 12 to 18 months. And historically, we think that is where inflation should live. So just because of one high 24-month period, at this point, at least, we're not making the recommendation that we increase that inflation assumption across the board for the duration of clients' retirements.
But if they want to look at that, what keeps them up at night, what worries them, we do have the capability to do a what-if scenario on that. And that's one of the true huge values of the Live Well plan. Clarity leads to confidence. Confidence leads to comfort. We talk about the 3 C's. And if that is something that is of interest to tweak that number higher, we certainly can do that.
And so here, this might seem like a random slide. Globalization is not dead, and it is a little bit random, but we've gotten quite a few questions over the past few months about this and thought it was worthy to add. The question or the comment typically has gone like this. Well, you're seeing all these technology companies move the tech production back to the US. What is that going to do to globalization? With the idea that globalization has really helped drive economic growth here in the US, but also around the globe. And while we think that is true, you are seeing a lot of companies move production back to the US. We don't think it's necessarily globalization is stopping. We think it's going to be more of a restructuring. We would expect the big losers to probably be China. You're seeing a lot of companies move their supply chains away from China, or at least part of their supply chains away from China, with the hopes to not get caught in a COVID type of mess where their workers just won't show up due to local government. So we think globalization continues. We think there continue to be a big market for the multinational companies that we own, some of the dividend aristocrats that have operations here domestically, but also across the globe.
So if we summarize sort of the price group outlook for 2023, we think a recession is around the corner, not a severe recession, but months in the making. And again, we have an investment policy. We have a process to work through and invest through a recession. That's not anything to lose sleep over. Federal Reserve's interest rate policy. The Fed is the gorilla in the room, and we are certainly aware of what they're doing, what they've done, and looking forward to what they may do, and have adjusted fixed income portfolios accordingly with regards to that. Inflation, we think inflation slows down, but we still think it's out there. Obviously, what happens to the price of energy is a big unknown there going forward. We think compared to 2022, this year, 2023 will be a smoother ride. Matt just did the slide on globalization, not dead. Bonds, better year in 2023. We talk about bonds are back. Brighter days ahead for stocks. We do not think the bear market continues for another negative year, although again, we're tempering expectations with regards to what we think will be an average year. If we can be sitting here this time next year, and we look at a 6 or 7% net return on a stock portfolio, we're going to feel good about that. Not as good as we did in 21, but certainly a lot better than the average stock investor did in 2022. And again, if you look at that and you say there's going to be limited returns relative to what some people think the average of the past at 10%, dividend stocks continue to be a good place, in our opinion, to hang out. Again, our secret sauce with several different flavors of those. Fundamentals matter. That sort of continues to, we think, resonate with people who are investors as opposed to speculators. And one of our themes that we tried to show leadership on is thinking ahead, don't follow the herd. And as we've showed several slides, the average investor many times is not correct, shown by pessimism in the average investor is typically a contrarian indicator. So we would say, don't be a sheep. Have an investment process with regards to fixed income. Have an investment process for your stocks, and you have a live well plan. Matt, a segue to that. That's very helpful as well.
Yeah, and before we do, for those paying attention, these are also the 9 themes that we wrote about in our blog last week. So it's no coincidence that it showed up here in the presentation as well. So if you want to just a little more written literature, you can see the blog on our website. It's also a good plug. If you're not a client, happy to add you to our, we call it the Retirement Insider, our weekly email that we send out with blogs and our weekly market commentary. But the Live Well plan, a lot of clients on the call, let's just review our process. And I think it's a good time to really, if you haven't in a while, knock the dust off the Live Well plan and review some of the inputs. And what most clients have really been surprised by is even after a down year, it hasn't thrown them off track. And the reason for that is we plan for down years. That's part of the Monte Carlo simulation that we're doing is we're including down years in the market. But retirement's not an event, it's an ongoing process. We don't think you really have a plan until it's written down. And this Live Well plan, we use it as a retirement roadmap. Help us answer the hard questions of how much can you spend in retirement? How long will your money last? And that third bullet point down here, what rate of return do you need? We call that our family index number. And that's our personalized measured rate of return for each family. So you could have worked at the same company as your neighbor across the street, and you could have a completely different family index number than your neighbor. Just based off your needs, your wants, your goals and desires, and also your risk budget. So our goal is to replace some of the complexity with clarity with this, and we are tracking your performance, not against some arbitrary index, the stock market or the bond market, but against your family index number. And that's the number you need to be successful in retirement.
So I mentioned this just a moment ago, but an investment process we think is critical. Many investors, unfortunately, will make poor financial decisions during periods of stress. Their emotions get in the way, and actually the psychologists have shown that a part of the brain actually doesn't work as well. That's more logic oriented. So we think discipline and income generation are really good principles to follow, and those are 2 of our core principles of our process driven. And process driven means that the results, the risk, the expected return are going to be repeatable over time. But our goal here at the Price Group is to preserve your assets, also generating the level of income and growth you need on a real basis to meet your objectives and with confidence. We talk about the 3 C's clarity, comfort, and confidence. And again, an investment process will give you just that. As an example of investing without a process, you can look, a little bit of a busy slide, but you can see that this is a chart of when people put money into U.S. mutual funds and also exchange traded funds, ETFs. And you can see that there was a lot of selling at the bottom. When things went on sale, people said, I'm scared, I'm going to get out. And that was the time to be a buyer. You know, we joke about the process. How do you be a successful investor? You buy low, you sell high. The average investor over time has done just the opposite. Famous manager for one of Fidelity's mutual funds was asked what was his biggest regret, and the reporter who asked thought he was going to say, I should have bought XYZ stock, or I should have sold something at one time. And he said, oh, that's really simple. The average investor in my fund came nowhere close to the average return of my fund. And the reporter didn't get it, and he pressed, and he said, well, we can track every investor and whether they put money in or when they took money out. And he said, again, on the averages, people put money in after things had done well, and they took money out when things weren't doing well, which is the opposite of what was the best thing to do for success.
So here's a look. We think dividend income matters. It matters before retirement. It matters even more in retirement. But this is a breakdown by each decade and a percentage of the dividends of the total return being dividends plus or minus the capital appreciation by each decade. So you can see from 1930 through the end of 2021, about 40% of the return came from dividends. And in decades when the market is doing really well, that percentage is smaller. In decades when stock returns are more muted, that percentage will be bigger. We are of the opinion that we might have more muted stock returns for the next decade. And if that's the case, dividends are going to play a larger role in your overall total return. And we continue to believe that dividend stocks are a great place to hang out.
So the foundation of what we do as a fiduciary here at the Price Group is create a live well plan. That talks about we're a little bit corny and calling it a live well, but our clients tell us they like living well. So we will, if you're not a client, a meeting with us will help get on the road to that clarity, comfort, and confidence that we've talked about, and take some input, some information, and create a live well plan, which we love doing, and we think speaks well to again putting you on the pathway to enjoying life more and worrying less. So with that, Matthew, do we have questions that we need to address?
No, one question came in earlier, which we kind of answered just with one of the slides. No other questions, but if you have any questions, email Randy, myself, and we'd be able to take a deeper dive at anything and everything.
So that is the Price Group: Maddie Kearns, Tiffany, myself, Matt, and Melissa. And we would be honored to sit down and visit. As we tell folks, when we sit down and talk, we're both going to know if there's some common ground. If there is, we'll move forward. If not, we shake hands, part as friends, no cost or obligation. We do appreciate your time. Again, reach out to us if we can help in any way, and have a great rest of the Wednesday afternoon. Thank you so very much for joining us. Bye-bye.